From an early age, most of us are handed a very strict financial rule. Debt is an inherent danger, and borrowing money is a risk that should be locked away and avoided at all costs. Society conditions us to view credit cards, personal loans, and financing as hazardous traps designed to keep us broke. And for the vast majority of people, this is a completely justified survival strategy. Without a solid plan, owing money usually leads to ruin, making the avoidance of debt a rational way to protect yourself. That treating all loans like a contagious disease creates a massive psychological barrier. It stops the average person from looking closer and understanding the exact mechanics of how wealth is actually built. The fear we are taught stems from what is known as bad debt, borrowing money to purchase depreciating items, like the latest gadgets, luxury clothes, or brand new cars. This diagram maps out the classic consumer trap. Cash flows in from a paycheck, immediately draining out to cover the monthly payments on those phones and cars. You keep paying indefinitely, but you retain zero lasting financial value. If borrowing money is a mathematical dead end, you would expect the richest people on earth to carry zero balances. Yet wealthy individuals and massive corporations hold staggering amounts of debt. Curious, the hazard does not lie in the debt itself. The danger is dictated by where that borrowed money is applied. The wealthy do not achieve their status by simply out-earning bad spending habits. They operate using a different logic, treating debt as a tool for acquisition rather than a means of consumption. The deliberate opposite of that consumer trap is good debt. Good debt means borrowing funds with a strict singular purpose, purchasing assets. This involves acquiring commercial real estate, buying an established business, or funding cash-generating investments. On the left, a loan buys a vehicle that instantly shrinks in value. On the right, borrowed money acquires an asset generating recurring income. Saving cash for it could take decades. Borrowed money secures the asset today, allowing growth at a higher rate. Using debt to acquire assets means the primary financial goal is no longer short-term consumption, but the maintenance and growth of equity. The engine driving this strategy is called leverage, the practice of using other people's money. Leverage lets an investor control a large opportunity with a small fraction of personal capital. If you secure a 5% loan for an investment yielding 12%, you create a spread. That 7% margin belongs to the investor, generated by the bank's capital. A traditional debt-free saving strategy is structurally incapable of matching this pace. Leverage accelerates wealth creation by multiplying purchasing power far beyond what personal income alone allows. Wielding leverage is not about taking blind risks. It relies on strict calculation and timing before a loan is ever finalized. The primary protective mechanism is cash flow. Investors require the acquired asset to generate enough consistent income to cover its own loan payments. The property or the business pays the bank, not the investor's personal paycheck. Beyond cash flow, the tax code provides another layer of utility for investment debt. The interest paid on these specific types of investment loans can often be subtracted from an investor's overall taxable income. This reduces the final amount of taxes owed at the end of the year. This structure is designed to mitigate the costs of borrowing, making the debt a manageable component of a wealth-building plan in a way that consumer loans never are. When you strip away the emotion and look at the math, you see that debt is amoral. It possesses no inherent goodness or badness. Debt acts as an amplifier. It multiplies whatever financial habits and discipline a person already possesses. If habits are poor, borrowing accelerates ruin. If the strategy is sound, it accelerates growth. The poor often avoid debt out of fear, remaining constrained by past liabilities and limited cash. The rich use debt to accumulate future assets. The ultimate barrier dividing these two groups isn't initial access to capital. The true barrier is the financial knowledge and discipline required to manage leverage. The choice is between maintaining a reflexive fear of borrowing or learning the technical requirements to use debt as a tool.